All right, so today's goal, we're going to try and provide some greater insights into some key factors that are going to be impacting deal values and share some practical steps that you can use to position your company for sale. So we're going to start out with just a brief introduction of Taureau Group. I know Corey did an excellent job on the video going through that earlier, so we'll keep that very brief. We're going to go through a few slides on the current M&A market to give you a flavor of what we're currently seeing. And then we'll jump into kind of the key value drivers, which is going to be 5 different topics that we'll go through. We'll finish up with some planning considerations and then conclude it. Hopefully we can get all this in 45 minutes. Corey and I were kind of joking before that this time goes by really fast, so we're going to do our best to avoid delaying you guys getting to drinks here.
And feel free to ask any questions as we go through this. Seriously, we're not going to get probably through 3/4 of this presentation. So a little bit on Taureau Group, just to go into some things that you didn't hear in the main part of the program, is we really look at bringing the bulge bracket experience, the service, but doing it on a very responsive level. So what we pride ourselves in is white glove treatment for our clients. Service them, educate them, guide them through every part of a transaction. The other things to just notice, most of our transaction sizes are about $15 to $250 million of enterprise value. That's EBITDA, generally between about $3 and $20 million of EBITDA. We do certain deals outside of that range, but that's generally where most of our clients factor in. We're generalists by trade, but we do more and more work by industries. So we have certain verticals that we focus on, as mentioned here. About 65% of our work is in industrials and contract manufacturing. So that's a significant one. Obviously, we're in Wisconsin, a lot of manufacturing here. You see a number of transactions up there as well. Our team, I won't go through it in person, but there's many of them here today. The thing that one another thing that makes us unique is we always want to leverage operating partners where we can. So we have certain operating partners on our team connected with us that guide us on certain former CEOs, former CFOs, legal, and then also in the steel specialty area that we do a lot of work in. So we want to leverage that always for our clients' benefit.
All right, now we'll go into some M&A market insights. So you heard some of the speakers before talking about the current M&A environment. I think overall, we're seeing that it's still a very robust M&A market. There are certainly some headwinds, which we'll get to in a second, but one thing to note is on the private equity side and also the corporate side, there's still trillions of dollars of money that needs to be put to work. And so with private equity groups, they're obviously in the business of investing in companies and then getting their investors a return. So to do that, they actually have to buy companies, right? So because there's a lot of money out there, there's still a very frothy M&A market from that standpoint, a lot of demand. Now, I will say some of the headwinds that we are seeing do center around the tariffs. There's a lot of businesses that have been impacted by tariffs. There's one business in particular that I'm working on currently. 50% of the sales come from products that are sourced from China. We've had a very difficult time over the last, call it 3 to 4 months, in moving that process forward, given all the uncertainty. As you can imagine, one day it's 0% tariffs, the next day it's 10, now it's 50, next week it could be 75, we just don't really know.
200% on French wine. Right?
There you go. Well, we're not representing a French wine company just yet, but that certainly could be an impact. But nonetheless, I think from any investor standpoint, one of the biggest things that they're looking at is deal risk and And when you have a lot of uncertainty, that's extremely risky and creates some difficulties. So that is one area that is a big focus. I think the other thing that people can generally see is the interest rates. You know, going into November, we were thinking there might be 4+ rate cuts in 25. Now we're maybe at 2. So some of that is also curtailing a little bit of the M&A cycle here. But overall, I would say for quality companies, there is a high demand. As I mentioned before, with the $1 trillion of assets on corporate balance sheets and private equity money, they want to do deals, they need to do deals. So if you have a great business, there's going to be a lot of interest.
And all in all, it's a pretty good market out there yet that we're seeing, but very similar to like the real estate market. So there's just not a lot of good quality homes out there. Same thing with the world of M&A. There's not a lot of good quality businesses that the business owners are willing to go and sell. Even private equity firms are not selling businesses right now in general. There are plenty that are doing it, but a lot of it depends on the underlying business. Certain businesses that we're seeing, those serving the data center market, the other tech market, home service market, they're doing really well. But those that are maybe into ag, automotive, in general industrial, they're struggling a little bit at this point in time. And struggling is a relative word because coming off of a 20-30% annual growth rate that every business saw post-COVID hangover, they're now used to flat, or maybe they're down a little bit. They're that new normal, but business owners are thinking it's challenging. So the market is very good, it's very resilient, but we need to see more sellers out there.
Yeah, and John Deere has been a big impact too locally. I don't know, show of hands, anyone do work with John Deere? Yeah, a few people. I'd say if you talk to those individuals in the cocktail hour, they'll probably tell you that, you know, the pipeline is down, and that has impacted several manufacturing businesses that we've, worked with or are looking to work with in the future.
So continuing forward, talk about the market a little bit, and we'll talk about this very basic on this slide because there's charts here and everything's aggregated when we look at businesses. This on this slide is large companies, so it's all M&A transactions. The one thing to notice, about 15% cross-border transactions. We've seen that increase over a period of time. You'll also notice 2021 stands out there. It was alluded to on the panel earlier. That's an anomaly year. You know, the valuations were high, the volumes were high, everything was expected to repeat in 2024. We're not seeing that though. We're kind of seeing the normal. Things are stable, things aren't out of control in any way, whether it's valuation or volume. The other interesting dynamic on this page is about 65% of the buyers in these transactions were corporate M&A. And 35% sponsor backed. When we look at our transactions over a period of years, it's about 67% going to the combination of strategic PE and strategic corporate. So very, very similar to the dynamics that we're seeing across the board here. On this page, we get down into our world a little bit more. So this is the lower middle market, deals generally $250 million and below. Also very stable. Now you're seeing a little bit of a downtrend here, 22, 23, 24. Nothing to be overly concerned about because also you can look back at 2023 or 2003 to 2019 at about 6.6%. So overall, we're in a really strong market, still good valuations. And again, a lot depends on the underlying businesses that this is based on. On the right side of the page is the manufacturing, business services, and distribution breakout. You see how in manufacturing we saw 2021 at 7.1 and then 24 at 6.9. So again, stable, a little bit lower overall than the market in the manufacturing world. This is all looking at private equity transactions through GF data. And then down below is something that we refer to as the quality premium on transactions. Now this is to get somewhat objective. This is based on the growth rate of a business and the margin percentage of a business. But there can be other subjective factors that create a quality company. Now I would say, as no surprise probably, every business owner that's selling thinks their business is a quality business. And I would argue that they are not all quality businesses. So we have to be honest. We'll go through some of that as we continue through the presentation here. But something to be aware of, a quality business is going to get a significant premium compared to a business that isn't seen as quality. And there can be other factors there.
All right, now we'll jump into a different section here on value factors and control. So what you can see on the screen on the y-axis is going to be the impact to business value. So the higher on the chart, the more business value you get. On the x-axis, you have the amount of control. So this would be from an owner standpoint or a management team standpoint, how much can they control for this? Now, what you really want to try and focus on when you're looking to sell your business is what you can control. Obviously, you can't control the historical financials. So don't pay a lot of attention to that. We'll help you create the story to tell that's succinct and makes a lot of sense and gets a lot of interest, but unfortunately you can't change the past. The economy, can't do anything with that. So what you really want to focus on is what's in the upper right-hand corner. The things that we'll go through in a little bit would be, growth opportunities. So where do you see your company moving on a go-forward basis? Investors, whether it's private equity groups or strategic corporate buyers, they're not buying you typically to just stay as is. So the growth section is an extremely important section of a marketing materials. And this is an area that as the management team, you want to spend the bulk of your time as you get ready for your sale. So the other things to think about would just be the management team and also the owner transition. We always kind of like to say the owner should really start to look at transitioning themselves out of the business. It's great for them to stay involved in some capacity, to still take a salary and a bonus. We can add all that back. But in an ideal world, if the owner is inconsequential to the business and a management team is running it as a standalone, that's going to achieve a very high value for an outcome. So just some things to consider, and we'll go through several of the factors here today.
One of the components on here is backlog and pipeline, and this has really gained a lot of traction and interest over the past few years, especially after COVID. Every buyer wanted to know what is the pipeline of the business, and partially judged by the backlog of the business if they maintain a backlog. So a lot of our clients come to us and they say, well, we don't really have a pipeline, we don't really have this visibility. If you can get that visibility, your business is more interesting. You can support the sustainability of your business, possibly the growth of your business going forward. It's something that's worth time to put into, to come up with some sort of metrics to understand all of that and how it fits. You're not going to have 100% visibility, but make some guesstimates, some educated guesses on how you can put that together.
Good. So the areas that we're going to talk about here now are really the 5 areas of focus from a buyer's perspective. So when you go to sell, these are 5 areas that you want to have buttoned up to really maximize value. The first one that we'll talk through is performance and financials. The second one will be people and infrastructure. The third one will be how you position your company relative to your peers and your competition. The fourth would be your growth potential. And then the fifth is kind of, the problems which all companies have. It's not a big deal, but how to identify them and bring them up early so they can be supported throughout the transaction. And a lot of this is going to be well beyond just the metric that we all talk about of EBITDA. There's a lot more that goes into the value of a business than just looking at what's EBITDA. And so we'll talk through those here in a second. As far as the performance and the financials, I think, some of the panelists up there even alluded to it, making sure that you have clean books, that you have the proper, accounting. A lot of our companies that we're representing are going to be repping to GAAP. And so if you're not on an accrual basis, maybe you're on a cash basis, this is an area that you would want to work with your accounting firm prior to getting engaged, because most purchase agreements are actually going to look at and state that you need to adhere to GAAP, and then there could be some deviations. So it's really important to understand what is GAAP net income and EBITDA.
That's an area that's changed quite a bit over the last few years. We used to sell businesses, and buyers were generally comfortable that there would be a rep to historical accounting practices, and that's changed. Now it's really adherence to GAAP, possibly GAAP with some deviations that are disclosed, but that's changed. So it's more important to be aware of what is GAAP. So have a good relationship with your accounting firm. If you don't have an accounting firm, you only do tax returns or something like that, definitely worth the investment.
Yeah, and I would say as an example, so we've worked with companies of all sizes and all varying degrees of financial consistency, maybe is the word to use. One example I can look back on a couple of years ago was we were working with a business owner. He was running the business pretty much as himself. He was the CFO, the CEO, and he was using QuickBooks to really run his business. Nothing wrong with QuickBooks, but the sophistication that he went through in his business, which was probably $30 or $40 million in revenue, there just was a lack of, on the accounting side, the way to reconcile accounts, the way to group certain accounts according to GAAP. And what we found is when we worked with them, there was a lot of inconsistencies month over month. One example was, we'd get the monthly statements to update the trailing 12-month EBITDA, and the prior month had changed. The numbers had changed. We're like, what's going on here? So I think the better handle you can have on your financials before the process, that really helps speed things up, and then we can focus less on the mechanical function of getting the statements correct, and really focus more on what are the trends telling us? What are the margins saying? What are your customers doing? We want to spend more time on the exciting things about your business rather than creating uncertainty and having some inconsistency in the financials. So it does go a long way to having those correct and getting that work done up front before you start the process.
A lot of times we'll go through the financial statements, and we do a really heavy analysis on the financials when we're preparing to go to market. But a lot of times we'll ask the business owner or the CFO or someone in the business, what happened? Why is this a trend this year? And why is your margin growing or shrinking or vice versa? And they'll give us a story, but then we'll dig deeper into the analysis to prove the story, and it's not accurate. So know your financials and actually what's happening that is driving your financials. A really important thing that most business owners, they guess on. Sometimes they're right, sometimes they're not.
Yeah, the other thing to just mention on this topic, and I don't want to spend too much time because Corey's got a bunch to talk about too, but I will say one of the things that has been elevated in the last decade since even I started has really been the analysis on what is your margin by product, by SKU, by customer. And I think 10 years ago, that was a very difficult question to answer for a lot of small businesses. There have been such a leap in technology and people implementing ERP systems that do cost accounting, and you can get that level of detail. And what that does for us as your advisor is really help to tell that story about why certain products are performing the way that they are, why margins are up and sustainable. And that really gives us the ammunition to increase value as much as we can. So if you aren't doing those type of things where you're looking at margins by customer, SKU, product line, et cetera, you should definitely start to do that. If you're already doing that, kudos to you.
Price volume analysis has been significantly understood over the last, when commodity prices doubled after COVID, people couldn't get supply of products and they were charging anything. That's where we saw the real driver of how much price or volume was going through. And we saw companies double their EBITDA without producing any more volume of goods. So it was pretty interesting as you look at that and a buyer trying to understand what is the sustainable level of EBITDA in the business. All right, moving on. The other actually thing just on the financials before we go over is until COVID, every buyer always asked, okay, well, how did you perform from 2007, 8, 2009 through the Great Recession? And that was always something that we wanted to understand so we could go to market and be prepared for that, because they looked at that as it's going to repeat at some point. Since COVID, we really don't get that question anymore. Maybe it's coming back, but I haven't gotten it for a while. People are really trying to understand, how did you perform during COVID? So very different economic dynamics during each of those, but people are looking back at the last cycle versus going back to the prior Great Recession. When we look at people in infrastructure, this is an area that I think is often under addressed as people prepare for a business. Sometimes it's buyers or sellers of businesses that just don't want to put the right people in the seat. They've been the owner. They don't feel like they need a CFO because they don't want to pay for a CFO or an operations person or something like that. But it's very, very important to understand who's in the seats and do you have everyone there. It's also important to understand who's exiting the business. So if you're key to the business and you're looking to sell and potentially get out and go to the beach the day after close, that's going to be a concern for certain buyers. We heard Kip from Potawatomi on the panel today. He wants to make sure that anyone that they partner with is going to be there for a while because they're not experts in the business that they're buying. So it's really, really important. Also, if you are looking to do that transaction, and we've had plenty of clients of ours say at the beginning of a deal that I'm willing to stay on a few years, but then they start going through the deal, they start understanding the process, and they start looking at what the net proceeds are that's going to be in their bank account. And then they start getting excited for that next chapter of their life. So if that changes and it's in the 11th hour or in due diligence post-LOI when that changes, you might lose a buyer very quickly. And we've had that happen where our client says, I can't control it. It's just the way I feel today. I want to be out right away. The buyer might have planned otherwise and the deal gets lost. So that's a real challenge. Understanding what's leaving with anyone leaving the business. So if you have if you're in charge of all the sales relationships, the customer relationships, and you're leaving, whether or not you think that's going to be an issue, the buyer is really going to focus on that, and that's going to be an issue. So the more, as Tyler mentioned, you can work yourself out of the business, the better. Also, Uncle Bob. Is there anyone in the business who should leave? We've seen a lot of examples of this. The people in the business that they say, they kind of do something, but not a lot. They maybe add back their salaries, their compensation. Just get them out of the business. That's a conversation.
Easier said than done sometimes.
That's a conversation a buyer doesn't want to have with them, and we don't want any issues with getting them out of the business as we go through the process. We've had deals before where we're going through the process, and that Uncle Bob is someone that actually has ownership or has some sort of, maybe they have an employment agreement that has a promised compensation that's above market. And the seller just says, they're a small owner, or they're just my uncle, we'll get rid of them. Well, it doesn't always happen like that. And in the 11th hour, they have a lot of control to make sure this deal goes through. So they can pull a lot of strings there. How much of the business relies on certain people, and can you go through a transition of these people? One thing I just want to mention here is, as you're planning to go through a transaction, and you might want to work yourself out of a job, you might have a CFO that's retiring, you want to bring someone else on that's a younger CFO that's going to be there for a long period of time with the buyer. We can add back or adjust out of the income statement duplicative costs. So say you have a CFO that's looking to retire, a buyer's going to want a CFO in there. bring them both on. It's not going to impact the financial performance of the business. It might impact your cash flow a little bit, but it's not going to impact the financials that we present to a potential buyer, and that's a pretty acceptable add back. On the running the business, it's most important to really make sure that everything's demonstrated, the processes are formalized and all of that. The more knowledge that leaves the business, the more challenging. All right.
Was there any questions, by the way? I know we covered quite a few slides, but just want to take a brief moment if there's any questions. No pressure. All right, we'll continue on. Feel free to raise your hand if you do want to ask a question.
Moving on to the position. This is an area where when you look at preparing your business for a sale, and even when you're positioning your business, talking about it, going through a process, you really have to be honest with yourselves, because a lot of this is very subjective to go through. So it's always helpful to get some third-party insights here. You know, when we go through diligence, or a buyer goes through diligence, we're generally going to do some customer surveys or market knowledge to understand what the position of your business truly is. And private equity will spend a lot of money to have this assessment done. So we're going to find out, or the buyer's going to find out, what really does differentiate your business. Is it quality? Is it service? Is it price? Whatever it is, you need to understand what it is that makes it important. If it's price, how long can you be that price leader? Does that require you to continually invest in equipment or processes? Or are you just the price leader because someone hasn't caught on to you yet, and if they can compete well with you to where your margins aren't sustainable or your business isn't sustainable? Understanding the defensible market positions of your business is also something that's widely talked about as you put together a book of what your position in the market is. So do you have really strong customer relationships? Maybe there's PPAP involved, maybe there's tooling that is unique and you did a significant upfront investment to where it's hard for that customer to transition to another potential vendor. Also, it could be integration. Are you heavily integrated with that customer to where you're going to their job site to work on engineering plans and mechanical changes or manufacturing processes? That integration is something that gives you a defensible market position. Brand name recognition is self-explanatory. Superior products and capabilities. Do you have equipment? We'll talk to certain clients of ours. They'll have equipment that no one else in the U.S. has yet. That's a significant differentiator why their customers want to work with them, because generally that equipment allows them to produce higher quality, higher tolerance, or more efficient. And then product line diversification is so important. And there's a lot, when we talk about lower middle market companies, a lot of companies have concentration, whether it's customer concentration, vendor concentration, or even product line concentration. But in this market with so many uncertainties, that has become really important. For example, a former client of ours I was just talking to the other day, he said their general industrial business is down about 30%. That made up about 50% of their volume. But he said on the other side, their data center business, which they never planned on growing the way it is up so much that their overall business is flat. So that diversification can even things out quite a bit. If you're all in one segment, going back to the automotive, the agricultural, you're in a challenging environment in certain positions.
All right, now on to topic number 4, potential. So with potential, what we're really getting at here is, what are the growth opportunities? It is okay to say that you want to just add more salespeople, but we usually need to give some additional detail as to why you want to add salespeople. Is that because you have new products that you want to offer? Do you want to go into new geographies? Do you have new customers that you're going after? These are all the things that, as an owner and a management team, you should be thinking about. I'd say one of the low-hanging fruit that you can do ahead of selling your business is really putting together a financial projection. And it doesn't have to be, a master level Excel workbook. But I think a lot of business owners could really benefit from going through this exercise with their management team. And one example would be, we're currently working with a business. They did not go through a project or put together a projection model at all for their business. They're a capital equipment provider. They usually just look at what is the budget for this upcoming year. Well, in this last, call it, couple months, we've had some challenges with the backlog and what buyers wanting to know, okay, what does the next year and the year beyond look like? And so what we had to do to assist them was really put together a full projection model that did kind of a bottom-up approach from a revenue standpoint. So what we did is we took the percentage of completion accounting, we looked at their pipeline and their backlog, their historical sales that tended to be more reoccurring in nature, and started to build a financial model to assist in helping tell the story. Now, what that does is it really gives buyers some confidence that, well, I should say, we all know projection models are going to be wrong. So that is true. But I think it does give directional information, and it also just eases the concern that you're not just willy-nilly, going out with no strategy whatsoever. So one thing I would certainly encourage you, if you're looking to sell and you do not have a projection model put in place, is work with your team on developing something that you can use to tell the story about where you're heading from a growth standpoint. And if you don't have someone in your organization that can assist with kind of the financial modeling, there's several people here that I could introduce you to that are outsourced CFOs, and they can assist in kind of helping you build that model for a very reasonable amount of money. And that's going to really help kind of drive your strategy and get everyone on the same page. So something that, from a potential standpoint, you really want to build before going into the process. Now, if you don't, like I said, we work with companies of all different types, and we will assist in developing that with our clients, but it is very helpful if that comes up front and we can hit the ground running on other topics.
And just in starting early, if you start a projection process, and you get better at it over time, but if you start a projection process, whether it's customer-based or however you do it, and then you compare at the end of each year, what is your actual compared to your projection, and you're starting to get better and better, that builds credibility for future projections. So even if you aren't going through a process, it's a good idea to start thinking about that projection, how you can put it together.
No, that's a perfect point too, is you're always wanting to iterate and look at your assumptions from the prior year. How did we do? Because again, projections are always going to be wrong. You just want to be less wrong than maybe the prior year. You're always kind of improving.
And Tyler gives a good evidence is this is what the process of investment banking is. We don't just take company financials and throw it on to a buyer and say, here, give us a price. That's just one example of the analysis that we have to go into and get comfortable with before we start presenting it to buyers and going through the process. Just the projection, we've had clients where we spent months with them on that alone to make sure that they can get comfortable and stand behind what they're presenting. Because it's not only us that needs to present it, but then we need to be well coordinated with them as they present it through management presentations and through the entire process.
And my last point here, I know we're ping-ponging back and forth on this topic, but I think it's an important one. I think, now I just lost my train of thought.
That's okay, I got one. So on the potential too, for business owners that are running their businesses and they want to come up with other ideas on potential, and say they're also considering a sale of the business, you don't have to have an idea fully implemented to go through a process and get credit for it. So you might say, I want to get into a new geography, or I want to get into a new product line or something like that, or a sales channel. Start making the inroads, make the investment into it, show the capital investment that's required for it, the timeline and the process that you're going through. Say it's a 3-year process before you can really get some traction into a new sales channel. but you're a year into it, you've made the investment, you have a plan to get it through, a buyer is still going to give you potential credit for it or have a significant interest because of that.
I remembered. So it was that the information is better coming from you than from us. And what I mean by that is if you've developed it with your management team, you've created the projection model, you have the growth ideas, and we've kind of amplified it and helped craft the story. We're not the ones telling the potential buyers about it, you are. And I think you get a lot more credibility when it comes from you as the management team versus us as the investment bankers trying to explain the projection model and the growth opportunities. If they can feel it and they can see it in your enthusiasm, that goes a long way.
The fun slide, problems. Every business has problems. We have so many clients that we start out with and they say, my business is perfect, there's nothing wrong with it, buyers are gonna love this business. In the end of the day, there's problems. Everyone has it. So what we wanna do as a presentation is just make sure that we can communicate those problems, address those problems, and offer solutions at the appropriate time in the process. Generally, the appropriate time in the process is when you have other options. So I think it was on the panel where someone mentioned, if you're in the 11th hour and all of a sudden a problem comes out, that's the only buyer there. If that buyer can't get comfortable with the problem at that time, you need to start from scratch again or really back up the train and get another buyer involved. So it has to be communicated at the appropriate time. We tell our clients, we're not the IRS, we just want to know what's going on so we can present it appropriately. One other thing is put yourself in the buyer's shoes. You know, if you're looking at this business, what keeps you up at night? Is it, ooh, this equipment on the floor, it's been dangerous. I know OSHA's been in here a few times. We really need to look into that. Well, buyer's gonna understand it too. A buyer's generally gonna spend $1 million or so in due diligence in certain situations. Not all situations, but for certain companies. So they're skeptical of everything. They're gonna get the third-party people to do the research, do the analysis, and make sure they're comfortable, whether it's safety, environmental, union, or otherwise. So make sure that you are comfortable with all of those, and also that you're sharing it with your advisors, your investment banker, your attorney, your accountant. As we look at potential deal killers and retrade opportunities, concentration is usually one where we see a lot of issues up front. But that comes down to you have to go through the right process and you have to find the right buyer. If you have significant concentration, it might not be a standalone private equity buyer, but you might have more a strategic, a corporate that sees that as a large customer versus a risk to the business. So you have to deal with some of these items appropriately. Union issues, environmental issues. After doing 200 deals, we've been through it all before, but they are issues. You need to acknowledge them and you need to talk through what those potential avenues are. Creative attorneys, Marty, I see you back there. We've had to work through a few together, and having your advisors on board is always an important thing.
All right, then we'll get into our last section. We got a few minutes, Corey. We'll see if we can power through in 3 or 4 minutes here. We'll do our best. As far as kind of building value, 1 to 5 years out, some of these things we talked about, positive growth rates in sales and earnings, strong EBITDA margins, developing recurring or reoccurring revenue streams. Some of that just gets back to how do you reduce the overall deal risk? And when you have lower risk, you're going to generally have a higher value from buyers. Other things could be diversifying your customer base. We didn't talk a lot about this, but if you have over, say, 20 to 25% of revenue with one single customer, that can be problematic. And we have seen in certain situations that private equity groups especially will not even move forward past the teaser and take the book if there is customer concentration. So one thing you can do, 1 to 5 years out is really look at what is your customer percentage look like, or your stratification, and how can we maybe minimize or reduce the percentage of revenue to to some of your top customers.
And if I can add in certain things around customer concentration, you might have a sales concentration with that customer, but that's not as important as the profit that goes to that customer. Say you have 30% of sales concentration, but it's a low margin customer. Maybe it's only 10% of your EBITDA that drives down, or gross profit, however you look at it. It's not as concerning. Same thing if you have customer concentration, but that customer has 20 different sites that are making separate purchasing decisions. Again, that's a way to potentially mitigate that risk. So you have to look at some ways to get creative around it as well. And the last thing on customer concentration, where we've seen a lot of success, if you have a period of time and you prepare ahead of time, you can do some acquisitions to actually bring in some customers to grow around it. So we've seen some real successful plans. Again, that's not going to happen overnight, but if you plan accordingly, you can do some acquisitions like that.
While you were talking, I switched you to the next slide here.
Okay.
Just in the interest of time.
In the interest of time, we'll handle some of this over drinks, but building value from legal matters are important too. Understand the structure of your corporation, C corp, S corp, how you're looking at that, how the presumed tax structure is going to be, what you're selling for. We hear a lot about Section 1202, small business stock opportunities. So understand all of that stuff, formalize it, talk to your estate planning attorney, talk about the preparation with a wealth manager going through this, some in the room here today. So understand plenty of things that you can go through, and not a lot of time to talk about them right now.
And then we'll kind of round out the conversation here with, what you could do maybe 6 to 12 months before you're looking to sell. One thing that's overlooked, I think, is clean up your facility. It's maybe not obvious for some owners, but when you bring buyers through, you want to have a clean facility. It just, from your employees feel it, the buyers feel it. It just feels like an overall more safe place. Just like when you're going to sell your house, you're not going to just leave your sheets undone on your bed. Like you want to clean up to get maximum value. So that would be one thing, to just make it orderly. Otherwise, talk with your attorney about your potential employment agreements that you may need to put in place with your management team, who you would want to bring in. There's some good things that we could spend quite a bit of time on there, but you do want to think about how you bring in them into the process and potentially incentivize them to really help you with the due diligence and the management presentations and all of the things that go into it. And lastly, one thing that you can do is, if you have enough time, look to reduce your working capital. So this is a function that equates to money in your pocket. If you're able to lower your net working capital before, say the 12 months before, that could be increased dollars to you. And we could probably spend a 45-minute session just on net working capital alone, which we won't do here, but feel free to reach out to us and we can explain more about that. So with that, we're right at 5 o'clock here.
Thank you. They usually start kicking us out of the room right at 5, and they haven't yet. So if anyone wants more information from us, feel free to reach out to Tyler, reach out to me. If you want like a quarterly newsletter that gives some insights on valuations, transactions that are happening and so forth, we have a quarterly newsletter that we send out. And then we also have quarterly industry reports, industrial and contract manufacturing, packaging and print, tech and business services, and then medical device manufacturing as well. So just let us know if you're interested in any of that.
Yeah, last thing, if you do want a copy of this presentation, feel free to leave your business card up here, or find me later and give me your business card, and I'm happy to send you a copy. So with that, was there any questions?
Everyone's thirsty.
I guess we do have one.
Real quick, is talking most of the time for
Oh yeah, absolutely. It does change a little bit, but I'd say from a private equity group standpoint, like if let's say you're going to sell a minority or even 80% of your business, a lot of the steps that we've talked through here today are extremely applicable. It's more, how does that transition occur post-close? Who is involved in the equity and the rollover? And so a lot of the stuff that we talked through today is applicable. Corey, I don't know if you want to add anything.
Yeah, I would just say, you mentioned if you're talking about recapitalization where a private equity group maybe buys a majority of the business, that actually is probably about 60% of our sell side efforts. And most of our clients come into it thinking that they want to sell 100%, but then some of the opportunities that are there with recapitalizations, continued ownership, not necessarily employment, but it could be, and then leveraging someone else's debt without those infamous personal guarantees is nice as well. So recaps are a huge topic. We go through that. I would say about 60% of the time our sales are actually recapitalizations, and very, very similar preparation for such. Few things to think about a little bit differently because you might stay there as an owner. So a few topics that have to be discussed as we go further down the road. Talk about the equity, the percentage ownership, the rollover, and if it's tax-free or tax-deferred or not. So a few other things to talk about, but obviously we can do that a lot later. Anything else? Yeah. Well, most of our clients, while we preach the idea and the value of preparation, most of our clients come to us in October and want us to get a deal done by December. So very few actually want us to help with preparation. From our perspective, we do not get into the formal project of changing a business prior to close, but we are always available for conversation, meeting. We do certain valuation work that says, here, these are the 5 things that are really impacting your value and you need to change. So we get involved in a lot of that. But as far as a consulting project to put in a direct sales force, we don't do that. Anything else?
Okay. Well, thank you, everyone. We appreciate your time.